Good afternoon, everyone. As always, we are back with our monthly market outlook. If we look at global scenario, different countries have chosen different path and they are witnessing different outcome. There are countries from Canada to New Zealand where inflationary burst has happened, prices have declined, but that has come at the cost of growth. Belgium, China, inflation is down, but growth has suffered heavily. There are countries from US to Indonesia where growth has remained good, but inflation decline is little marginal. On the other hand, there are countries from Germany to Japan, including India, where growth remains good and inflation remains well under control. Different countries took different path and that resulted into different outcome. US threw money at the problem. India provided guarantees for the weaker sanction, and both have put them onto different outcome. Globally, inflation is easing across the world. Next slide, please. Courtesy falling inflation, most people expect central banks around the world, including US Fed, to start cutting interest rates somewhere from middle of 2024 and pick up the pace towards end of 2024. Next slide, please. If we look at Eurozone, that economy continues to remain subdued, and there are fears that countries like Germany and UK may go into recession as their fiscal support and monetary policy come to an end. Next slide, please. China, the second largest economy in the world, continues to remain. Can we request people to get muted? Yeah. The China, the second largest economy in the world, continues to remain on subdued growth path. The challenges of real estate sector, the NPAs in the real estate sector, along with consumers preferring not to spend but to save, is resulting into slower China growth. From double digit, it became high single digit, and from high single digit, it's likely to become mid single digit in the years to come. Next slide, please. Now, the worry is, like Russia-Ukraine situation impacted global supply chain and which had an impact on inflation or prices around the world, could the tension in Middle East, especially Red Sea getting blocked for cargo movement, could result into higher inflation? The container freight rate have jumped as Red Sea attacks have made it mandatory for ships to take a longer route around Horn of Africa. Will we see inflation coming back as supply chain gets prolonged? That's the million-dollar question. This is one of the favorite Twitter handle which I have been following. And he has mentioned stocks are trading like the Fed has already cut rates. Bonds are trading like rate cuts aren't happening. Gold is trading like we are on track for a soft landing. Oil prices are trading like we are entering a recession. And housing markets are trading like nothing is happening. All the markets around the world, all the asset classes around the world have factored in different outcomes, albeit time horizon is different. Which one will be proven right? Only God knows. Next slide, please. One equation which is in favor of emerging markets, including India, they are relatively very, very cheap vis-a-vis American markets over last almost 5 decades. US markets have done exceptionally well thanks to their Magnificent Seven. And emerging markets, bearing exception of India, hasn't done as well. Today, from a valuation point of view, emerging market looks very, very cheap vis-a-vis America. As there are uncertainties in debt, equity, gold, and real estate, lot of people are parking money in money market funds. Last month, our presentation showed $8.3 trillion parked in money market funds. Will this money move into equity? Then the corrections will be shallower and shorter. If this money doesn't move into equity, then the corrections could be deeper and longer. Has Chinese equity bottomed out? On a 30-year basis, China shares haven't delivered return to investors. Undoubtedly, Chinese valuations are very, very cheap. They are now trading at 1/3 valuation of India, around their historical lows. Next slide, please. China declared a rescue package of almost $300 billion to support their stock market. President Xi Jinping himself got involved in the discussion. With this kind of money coming to the rescue of stock market at 1/3 valuation of India, no wonder global investors are willing to take bet on China. Next slide, please. The fund flows into China has started increasing. Almost $12 billion worth of flows flew into China or China dedicated funds in last month. Next slide, please. Coming to US economy, Fed raised interest rates at the fastest pace, and afterwards they started taking out liquidity. Their balance sheets from about $9 trillion has declined by about $1.4 trillion to $7.6 trillion. The problem is that whatever money Fed is taking out, US government puts back in through fiscal spending and borrowing. The American growth has remained in positive territory, ably supported by large fiscal deficit. The post-COVID era has seen American deficits running upwards of 5% of GDP. The Fed has to borrow money on behalf of government of America. They are borrowing almost $100 billion every 13 days. Yearly run rate of Fed's borrowing for government of America will be more than $2 trillion. Their debt has already crossed $34 trillion as we speak. Courtesy large deficit, Fed US GDP growth continues to remain fairly positive, fairly robust, well above market expectations. It's not that US market or US economy does not have its challenges. They have their challenges, and that is able performance. S&P 500, if we look at it, the top 7 companies from Nvidia to Meta to Microsoft, their sales growth is 14%. Rest of the 493 companies put together have achieved 2% sales growth. Their profit growth is about 23% in terms of margin, whereas other companies' profit margin is just about 9%. Clearly, top 7 companies are doing wonderfully well in US, whereas bottom 493 companies are not doing as well. Next slide, please. Like in the global market, there is worry whether we will see inflation bouncing back because of supply chain challenges. The same challenge persists in US. If we look at the mid-70s of high inflationary era, US inflation had risen during Arthur Burns' time, and it again increased substantially after falling down during Paul Walker's time. Will history repeat this time? Will we see inflation spiking up due to supply chain or other issues? That's the million-dollar question. If we look at US economy, there they are witnessing K-shaped recovery. The credit card delinquency has surpassed pre-COVID time. US adult financial distress is visible. US housing affordability has worsened, and office vacancy rates are rising. There is challenge in US about theft happening at local stores, and up to certain dollars of buying or taking away, stealing, there is no penalty. Clearly, people are taking various kind of things, various kind of steps to avoid such things. Next slide, please. The real question is, will Fed keep rates higher for longer? Interest rates normally go up by escalator slowly and steadily, but they fall like elevator. Will Fed cut rates? That's the question. Today, market believes in March 24 there will be no rate cuts, but there will be rate cuts beginning mid-24. The headlines for India market remains broadly positive. We continue to remain oasis in the desert. Our macro financial and policy stability is visible. Growth, inflation, foreign exchange position, fiscal deficit, everything seems to be under control. If we look at activity, it's well above pre-COVID levels. GST collections are now touching 1,70,000 crore plus. So all in all, we are in a reasonably good position. The tax collections have remained robust, partly because of growth and partly because of compliance. As long as tax collection remains good, we will continue to see improvement of investments in infrastructure. The government, on the back of robust tax collection, is focused upon spending money on infrastructure which was built in last 10 years from 2014 to 2024 is almost double of what was existing in 2013. Central government, state government, and PSUs all seems to be focusing right now on rapid infrastructure buildup. Real estate was one sector which was struggling. As of today, we are seeing good recovery in real estate. Sales have picked up all over the country, especially of premium real estate. And we believe real estate should do well going forward. Banking system seems to be well placed. The deposit growth is lagging credit growth. Hopefully, RBI will improve liquidity situation, and then we will see deposit and credit growth remaining around current level. Most importantly, NPAs of banking system remains well under control. If someone would have mentioned Israel-Hamas war will continue, Houthis will attack Red Sea cargo movement, Saudi-led OPEC and Russia-led non-OPEC will cut oil production by 4 million barrels a day. One would have thought oil prices will be in $100 to $125 range. Surprisingly, oil, despite such challenges, have remained around $75, $80. This is truly divine for India. One concern is related to core sector growth. Core sector growth has remained little bit subdued in recent times. Hopefully, this will be an aberration and we should see recovery coming forward in the core sector. Core sector recovery can sustain if India captures China plus one opportunity. We are second best placed on supply chain relocation across peer group. And yet, a country like Vietnam gets double the number of proposals than India. The way we succeeded in mobile phones and toys, we need to replicate that across all other sectors. There is worry on employment in IT sector. This year, probably after many, many years, for the first time, IT sector will have negative recruitment. That means they will be retrenching more people than they are recruiting. This could have serious consequences for India job opportunities. While tech sector is seeing retrenchments, other sectors seems to be picking up, especially financial services. We need to ensure that organized sector, non-IT sector picks up the pace and starts recruiting jobs, starts creating jobs and recruitment to fill the gap or void left by IT sector. The other challenge for Indian economy remains consumption. The rural consumption is not growing as fast as the urban consumption. The premium market is growing much faster than the mass market. And the bottom half of pyramid consumption is not growing as fast as top of the pyramid. Consumer durables as well as consumer staples at mass market are witnessing lower growth than at premium end. How do we support consumption? How do we ensure that consumption revives and fires at the economy level? The urban consumption is holding well. It is the rural consumption which is a cause of concern. If we look at vote on account, it achieved trinity of impossible. On one side, it put money for inclusive growth. On the other side, it reduced fiscal deficit and yet provided sufficient money for infrastructure investment. These prudent policies warrant recognition by the world, and that is reflected in our premium valuation over our peer group. We trade 8 times more expensive than Russia, 3 times more expensive than China, and 2 times more expensive than Brazil and South Africa. This premium policy is purely function of our prudent policy. The day we lose that prudence, our valuations will narrow down. This vote on account, despite one before election, has ensured that there is no announcement of freebies and or reveries like last vote on account. We did see Pradhan Mantri Kisan Samman Yojana getting launched in last vote on account. There was fear that we may end up giving more freebies in this vote on account, but fortunately they have remained well under control. Coming to equity markets, The quarter three results for the December 23 quarter were generally in line or ahead of expectations. Sectors like IT, consumer staple, consumer durable, and one or two large private sector bank gave results which markets didn't like, but they were compensated more than sufficiently by results in cement, auto, real estate, construction, and other manufacturing sector like industrials and engineering. Overall, quarter 3 FY24 results has come well ahead of investors' expectations. We are well on course to achieve earning per share of about 1131 rupee for Nifty 50 for FY25 and about 925 rupee for Nifty 500 for FY25. There has been no major revision upward or downward in Nifty 50, Nifty 500 earnings based on December 23 quarterly results. Earnings growth obviously will be driven by domestic focused sectors. Global growth this year will be slowing down, and domestic growth will be twice or 2.5 times that of global growth. We believe sectors like auto, cement, real estate, construction will have better opportunity than exports focused sectors like IT. There has been a significant rally in small and mid cap. Lower the market cap, bigger the rally. We believe this rally is unlikely to sustain at this valuations. About 75% of profit pool lies with large caps. However, their contribution in total market cap is on decline. Normally, the small and mid cap trades at lower valuation than large caps, but now we are seeing an awkward scenario where small cap, mid caps trade at a higher valuation than large caps. This is one red line which is visible for small and mid cap. They were about 17% of total market cap in 2003. Today, they are almost 37% of market cap. This decline entirely has come in large cap. Generally, we have seen at such high percentage of overall market cap, small and mid caps don't deliver great returns. The earning yields of mid, small and micro caps compared to large caps is fairly unattractive, and risk return ratio this year is likely to be in favor of large caps. Obviously, no one can say when the momentum is going to come to an end. The party can continue well till the election. The market cap to GDP ratio against historical average of 80% today is around 130%, fairly high. And in order to sustain that market cap to GDP ratio, will deliver to markets' expectations in terms of growth, in terms of prudence, and in terms of governance. Large caps are trading at about 6% premium to the historical average. Mid caps trade at 20% premium to historical average, and small cap trade at about 44% premium to historical average. Next slide, please. FPIs have been dilly-dallying in terms of their view on India. They were big buyers in December despite Christmas holidays. In Jan, suddenly they become a seller. In Feb, they are again turning buyers. Undoubtedly, FPIs have been caught on the dilemma. Should they buy India, which trades at about 20-22 times forward earning? Or should they buy Russia, China, Brazil, South Africa kind of countries which are trading at significantly cheaper level compared to India? Next slide, please. We believe FPIs will be a buyer at lower valuation, especially as their holding in Indian equity is coming to the lower level last seen in 2012. Domestic investors, including mutual funds and insurance companies, holding is narrowing the gap with FPIs, and they have now relatively much less quantity to sell. Next slide, please. The domestic mutual funds, thanks to all of you, are sitting on fair amount of cash to absorb selling in case markets correct. While our cash balance is about 90,000 crore, in our asset allocation fund, we will have about 65,000 crore worth of buying capacity in case markets correct. The pension allocation to Indian equity is about 40,000 crore, and SIP flows have been growing every day. Collectively, local mutual funds will have firepower of 400,000 crore over next 12 months to absorb any primary or FPI supply. Next slide, please. There has been tremendous amount of flow into small and mid-cap funds. And this is one phase where we have seen a lot of small and mid-caps running ahead of their fundamentals. It is time to caution investors. Don't expect miracle. What return you saw in small and mid-cap in last 1.5 year are unlikely to be repeated in next 1.5 year. If you are investing in small and mid-cap fund, please moderate return expectations and take a longer term investment horizon. Undoubtedly, small and mid caps will do well over a long period of time as India growth story continues to remain supportive. But don't expect miracle. Don't expect returns like 2023 in 2024 or returns like FY24 in FY25. Small and mid caps continue to show high earnings growth, which is why these valuations are trading at higher level than large caps. Earnings growth is function of many things, and to sustain earnings growth to justify this valuation looks challenging, and hence our assumption is that this year return differential between large, mid and small will narrow down substantially and may look almost similar. One bubble which is building up in Indian stock market is low floating stock counters, especially in defense, railway and PSU banks. Almost all public companies have to comply with minimum 25% public shareholding rule. It doesn't apply to public sector companies. Their floating stock remains fairly low, and that is resulting into sharper price movement. Valuations of many of these companies looks fairly high, and I doubt if all these companies will be able to deliver performance which can meet investors' expectation. Surprisingly, in vote on account, divestment amount was restricted at 50,000 crore. It's way lower than estimated. When PSU market cap was 15 lakh crore, divestment was 50,000 crore. today, also when market cap is 50 lakh crore, divestment supply remains 50,000 crore. Hopefully in the budget, divestment amount will increase and the supply will ensure that PSU stocks will get traded on a better price discovery. As of today, our view, it's time to maintain equal weight in equity, but within that, be overweight large cap. Till last month, we were recommending marginal overweight large cap. Now we are saying overweight large cap. Till last month, we were equal weight to mid cap. Now we are saying marginal underweight to mid cap. Until last month, we were saying marginal underweight to small cap. Now we are recommending underweight to small cap. Time has come to take some profit in small cap and reinvest into large cap. Obviously, no one can say where the market's top will be. Do it on a gradual, calibrated manner, but do caution investors that if you are coming in small and mid cap, moderate your return expectation and enhance your investment horizon. Across our fund, our equity allocation and asset allocation product is somewhere around neutral territory. In Balance Advantage Fund, we are just around halfway at 51% equity allocation. And in multi-asset allocation, we again remain near halfway at 60% equity allocation. It shows we believe this market is fairly valued and hence deserves neutral equity allocation. Going forward, markets will continue to remain range bound. Indexes may not move as much as the stocks. Events like US Fed pivot, elections, energy price movement, and consumption recovery will influence prices. Every correction will be an opportunity to buy as India remains a long-term growth story. Coming to equity investment opportunity, our preferred recommendation is SIP. We still believe this is the right time or good time to do SIP, and it is reflected in more than 18,000 crore monthly collection. On a rolling return basis, most of our funds continue to deliver better return than benchmark indices in equity funds as well as in hybrid funds. On a point-to-point basis, in some of the funds on a 3-year basis, SIP returns are negative. Even on a 5-year basis, SIP returns are marginally negative. While absolute number returns are 29% and 22% and 25% kind of numbers, compared to benchmark, they have given lower return. This is on a point-to-point basis, as some of the expensive low floating stocks we haven't added. I'm sure time will again prove that we are protecting our unit holders' interest by avoiding that kind of momentum investment. Sorry, earlier was point-to-point performance. This is SIP performance. Next slide, please. Next slide, please. Kotak Flexi Cap Fund right now is witnessing on a 1-year basis underperformance to benchmark index. That's primarily because we have not invested in low floating stock, defense stock, railway stock, PSU banks as much as benchmark indices. About 2 months back in December end, FlexiCap was outperforming benchmark index. Right now it is underperforming benchmark index, but we believe our focus on valuation will eventually play out and we will soon be outperforming benchmark indices when valuation catches up with fundamentals. Kotak Multi-Cap Fund, which is invested across large, mid, and small, continues to do well and continues to add alpha, which is double digit in last 1 year. Kotak Equity Opportunities Fund, which is a blend of large and mid-cap portfolio, has continued to do well, and it has delivered mid-single-digit alpha across many years. I'll recommend you to also have a look at Kotak EQ Contra Fund. On a 1 year basis, it has also delivered double-digit alpha. Between Kotak Equity Opportunity, Kotak Multi-Cap, Kotak Contra, and our Harfan Fund, Kotak Flexi Cap, investors will get appropriate funds at this point of time. We are also in the process of launching Kotak Technology Fund. This NFO will open on 12th of February. As you are aware, technology plays an important role in our life. Everywhere, technology is playing an important role, be it financial services, be it e-commerce, be it healthcare and medical. This fund will continue to invest across these sectors. Next slide, please. If you look at 10, 15 years ago, a motor car, that was all about mechanical engineering. Now, as much as mechanical engineering, there is electronics and electricals involved. Motor cars now has millions of lines of code, which gives them better efficiency and better productivity. New age car involves complex technology with millions of lines of code. This will continue to expand going forward. And what happened in automobiles is likely to continue in many other sectors. Indian companies in large as well as mid and small has continued to ride the technology wave, from cloud computing to artificial intelligence to electronic management services to blockchain to fintech to cybersecurity to development of software products, engineering R&D, business process management, e-commerce, IT services and telecom. This diversified sectors will be universe of technology fund. This fund right now is getting launched at a time when technology sector is going through tough time. We had launched Global Innovation Fund at the peak of technology sector. We are launching Domestic Focused Technology Fund somewhere around bottom of this cycle. Profits have been under pressure, growth has been under pressure, recruitment is negative, and we still believe this is the time to wet your feet in technology sector. Eventually, they will figure out what they should be doing. Growth will come back, recruitment will turn positive, and we will see opportunity in technology sector in terms of re-rating. Coming to fixed income market, US bond markets have been in drawdown for last 41 months as Fed was raising rates. We believe now end is coming near for US bond market. US inflation is moderately high in December, but core inflation remains on the softer side. This will create room for Fed to cut rates somewhere in middle of 24. The markets was expecting rate cuts in March 24. Now they are expecting rate cuts to begin somewhere towards middle of 24, May or June. US Treasury yield is racing higher after some jobs data came in, but eventually it will start getting adjusted to Fed cutting policy rates. Vote on account was a pleasant surprise as it gave a fiscal deficit number of 5.1%. Market was at somewhere around 5.3, 5.5%. This means next year's borrowing program will be reasonably manageable. There is also debt FPI flow coming from June 24 to March 25. That should bring in about $25 billion, and that bodes well for interest rate. The net borrowing program at 11,75,000 crore is little below market expectation, and we believe the exit yield on Indian government securities will be with the big figure of 6% rather than 7% now at the end of the year. Indian bonds in anticipation of rate cuts globally as well as in India, along with lower borrowing program, has one of the best start as yields dipped about 10 to 15 basis points post vote on account. Indian yields are now at 7-month low with 10-year yield between 7 to 7.1%. The SDL yields have gone up as their compensation says it will no longer be available. That's about 1,35,000 crore a year. States may have to borrow more money if they want to continue to spend as much money as this year, and which is why state development bond yields have gone up, and it's probably attractive to invest in SDLs at this point of time. Liquidity remains tight as central government learns large balance. RBI in the credit policy did announce that liquidity will sort itself out, and they'll continue to provide limited liquidity through their VRRR auctions in the days to come. The tighter liquidity has kept short-term interest rates on the higher side. We expect liquidity to get normalized by March 2024. This gives a reasonably good data about how liquidity has tightened in last couple of weeks. We believe this will get normalized in the weeks to come. For last 2 months, we have been giving a call, go and buy the longest maturity. We believe December 24, March 25, 10-year yield will start with 6% figure rather than 7% as of today. There is a runway of 50 to 100 basis point rate cut, rate downward movement, and hence buying longest duration will be most preferable. Overall, interest rates will have a tug of war in the near term based on what US Fed does. But over a period of time, we see a 50 to 100 basis point decline in interest rates. On the fixed income side, dynamic bond continues to deliver better return than benchmark indices, and will recommend people who are looking fixed income allocation to consider dynamic bond fund. The hybrid funds asset allocation fund continues to provide low volatility and better returns. Almost all our hybrid funds have upside downside ratio of more than 2 times. And as of today, they have been able to deliver better upside participation and lower downside participation across most time periods. We believe these funds are appropriate for conservative investors, people who go to bank deposits, bonds, debentures, small savings instrument are unlikely to get positive real return, whereas allocating money into hybrid funds should deliver them positive real return. Kotak Debt Hybrid Scheme is a pure debt fund with about 75% debt allocation and 25% equity allocation. It continues to deliver mid single digit, low single digit alpha over last many years. Kotak Equity Savings Fund is equity fund from a taxation point of view. Net allocation to equity moves between 10 to 50%. The fixed income moves between 10 to 35%, which is margin money for funding some of the arbitrage position. And arbitrage position ranges between 15 to 80%. Overall, it has delivered far better return than benchmark indices. And more importantly, it will have lower tax rates compared to other instruments on the fixed income side. We have been positive gold since March 2020. It worked well in 2020, 2022, and 2023. It didn't work out well in 2021, but we believe gold should continue to outshine in the days to come. Our primary reason for remaining bullish on gold is central bank buying. In 2022 as well as CY23, they have bought 1,000 tons of gold. That continuous buying is keeping gold prices supported. This quarter also, central banks have continued to purchase their gold. One more reason to remain bullish on gold is expected rate cuts in US Fed. Whenever US has cut interest rates, it has generally supported gold prices. We expect mid-24 US to cut interest rates. That should give another boost to gold. Gold has delivered good returns, as I mentioned, since 2020, bearing 1 year of 2021. Other years have been giving better return than fixed income. There is a continuous need for Sarthi or mutual fund distributor or advisor in today's time. Today, we have seen a market where horses and donkeys all are running at a crazy speed. This is one pattern of a company where promoters have been selling and retail have been buying. Only a mutual fund distributor or advisor will be able to bring this to the attention of investors. Don't get into the trap of tips and telegram channels and social media pressures. Do your work, research, do your work, and then invest into the market. Don't follow the momentum. This is time to be cautious and careful. If people want to invest in PSUs, which has a strong momentum, my recommendation will be that go for a basket rather than a stock. There are some PSUs where floating stock is limited and valuations are high. Some still have decent valuation, and hence buying a basket might be better than buying a stock. We run Kotak Nifty PSU Bank ETF. This has delivered great return over last 1 year at 57%. We think this basket approach will be a better bet than single stocks. The mutual fund distributors are also necessary to convert people from traders to investors. While markets have seen one-way run-up, a lot of people who traded in cryptos, NFTs, futures and options, who played online gaming or went into Ponzi schemes have actually lost money. So mutual fund distributor advisor is necessary. Sarthi zaruri hai.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.